Welcome to the Opening Bell Report.
And today we are, jumping straight into a really high-stakes mission.
High stakes, high reward, for
Yes,
sure.
Exactly. We've got this analysis report, and it focuses on a stock that, frankly, sounds almost like a fantasy when you just look at the raw numbers.
Oh, it's a total jaw dropper. We're talking about Jet.AI, ticker JTAI.
That's the one. And the claim in this report is, well, it's extraordinary, a stock trading under 50 cents.
With analysts cited in this report, setting price targets of, get this, $8.
$8. I mean, do the math on that. We're talking about a potential upside of, what, 1,600%? More than 16 times your money?
Right.
In a market that's just full of noise, a claim that specific, that huge, well, it's a massive knowledge opportunity for us. Okay, let's unpack this.
Let's do it.
What's the general feeling, the tone of a report that makes a claim like that?
It's written with this very contrarian, almost aggressive energy.
Okay.
It's framed as a deep value hunter's dream. The whole idea is that the market has just completely misunderstood this company. It's been beaten down.
Left for dead is the phrase they use.
Exactly. But the analysis, which is dated mid-January 2026, it argues that JTAI is finally showing these undeniable signs of waking up. And it's not random.
Right, so there has to be a specific reason. If a stock has been basically flatlining, what's the ignition switch? What made it suddenly jump?
Well, it was abrupt, very abrupt. JTAI was just sort of languishing down in the low to mid 30-cent range.
And then?
Then, almost overnight, the stock just ripped. I think it was 13% higher during the day.
Wow.
And then it sacked on another 11% in the after-hour session. That kind of move, it's not just speculation, it points to a real material change.
And that change, the elephant in the room that everyone was betting against, was this merger deal.
The merger with Fly Exclusive, or FLYX, yeah.
That was the big one.
For months, the analysis says that merger was this huge weight on the stock. Investors were, and I'm quoting here, terrified the deal would fall apart.
Which would have left JTAI completely stranded, right? No capital, no strategic partner.
Precisely. And that fear, it priced in total failure, maybe even bankruptcy. The market was assuming the worst.
So then the news hits. But hang on a second. The news was about an extension. To me, that sounds like a potential red flag, not good news. Why would they need more time?
That's a great question, and it's a really important piece of skepticism here. The report addresses this directly.
Okay.
The crucial news that came out on January 14th wasn't that the deal closed. It was that Jet.AI and Fly Exclusive officially extended their merger agreement deadline.
To when?
To April 30th, 2026. And this was huge because it confirmed the deal was still alive.
So pushing the deadline out didn't scare the market. It did the opposite.
It was pure relief. That's how the analysis frames it. The interpretation was that the deal is emphatically not dead.
And the company leadership.
The CEOs were quoted as being enthusiastically committed to closing in the first quarter of 2026, so way before that new deadline.
So the market wasn't excited about the future so much as it was just relieved that the immediate disaster scenario was off the table.
Exactly. That relief did two things at once. First, it priced out that immediate catastrophic failure risk.
Right.
And second, for the more sophisticated traders, it priced back in what they call the merger arbitrage opportunity.
Okay, for anyone listening who might not be deep in M&A trading, can you just quickly break down what merger arbitrage means right here?
Sure. Think of it as a bet on a deal actually closing.
Okay.
Traders buy the target stock, in this case JTAI, at its current low price, let's say 45 cents, because they believe that when the deal finally closes, they'll get shares or cash worth much more.
They're banking on the gap between the current price and that future agreed-upon value.
Exactly. The extension confirmed that that bet was still very much alive. And that's why you saw this huge wave of buying come in off the lows.
That makes a lot of sense. The immediate danger is gone. The upside bet is back on.
Yeah.
But an $8 target, even with a merger, that seems steep if JTAI is just a tiny private jet charter company.
And that is the perfect pivot point, because
Yeah.
this is where the thesis gets, really spicy.
This is the core of the contrarian argument.
It is. The analysis insists that JTAI is fundamentally misunderstood. You hear jet, and you think planes, fuel, hardware.
Right, a heavy asset business.
But the bull case here is that JTAI is really a high-margin software company that's just disguised as an airline.
So the AI in their name isn't just marketing fluff. There's real tech there.
Absolutely. The report points to two specific proprietary technologies. The first one is called Charter GPT.
Okay, Charter GPT. It's described as the chat GPT for private jets. What does that actually do?
It uses natural language processing to automate the entire, very manual booking process for a private jet.
Which is usually a huge pain, right? Lots of phone calls, brokers waiting for quotes.
A huge pain. It's slow. It's opaque. CharterGPT, according to this analysis, just streamlines all of that into an instant automated transaction, and that lets JTAI capture a high margin fee on each booking without all the overhead of owning the planes.
So that puts it squarely in the scalable software as a service, the SaaS category.
Precisely. And then there's the second piece of tech, DynoFlight.
What's that?
It's their carbon offset API platform. It's a big deal for corporate clients who need to track and mitigate their carbon footprint from travel. Another high-margin software vertical.
Okay, so connect this back to the merger. If the deal closes, what happens to all this AI software?
This is the absolute centerpiece of the bull case. The analysis anticipates that the legacy aviation business, the physical jets, the low-margin charters, that gets spun off or absorbed into fly-exclusive.
And what's left?
You're left with JTAI as potentially a pure-play, high-margin AI software stock for the aviation industry.
Okay, and here's the kicker. The valuation.
Right. Despite owning these proprietary AI assets, the company's market cap right now is sitting at a, and I quote, microscopic $2 million.
$2 million. I mean, in this market, you see AI concepts with no revenue valued higher than that. The numbers just feel wrong.
It signals one of two things: deep distress or deep undervaluation. The bulls are obviously arguing it's the latter, all because of that merger uncertainty.
Which brings us to the valuation numbers that are supposed to support that $8 target. Here's where it gets really interesting.
It does.
We've got to stop trading, between 45 and 51 cents right now?
Mm-hmm.
But the report cites specific analyst targets from Fintel and Maxim Group, and they're placing the targets between $8 and $11.
8 and 11. Those are official, published numbers that create the floor for that 1,600% upside calculation.
Okay, let's inject a little more skepticism, though. When you see a firm like Maxim covering a microcap stock, sometimes that can mean the company is paying for coverage. Are these targets just, wishful thinking?
That is a vital point for anyone listening. And while that can be a factor, the analysis here hinges on the metric used to justify the target, not just the number itself.
Okay, so what's the metric?
It all comes down to the price-to-sales ratio, or PS. Right now, JTAI is trading at roughly 0.2 times its sales.
And for anyone learning to use these multiples, what does a 0.2 PS ratio mean for a potential software company?
It means the market is giving it basically zero credit for its revenue. I mean, none.
So what's a normal multiple?
To give you some context, a typical healthy AI software company trades at much higher multiples. We're talking 5 times sales, 10 times, sometimes even 20 times sales.
So the market is pricing JTAI like it's a failing airline, not a SaaS company.
That is the entire thesis in a nutshell. A staggering disconnect. The report suggests this valuation gap has to close once the merger risk is gone.
And if the market starts valuing it even a little bit like a software company?
Even at a conservative 2x or 3x PS, those $8 to $11 targets suddenly become mathematically plausible. The whole bet is that the market will see its revenue as high-quality software revenue post-merger.
That's a perfect way to frame the fundamental case. Now let's look at the technicals. The report says the chart is telling a story of capitulation and now reversal.
Right, the technical analysis gives you the roadmap. It shows you when the selling might be over.
They talk about something called the flush. This refers to that brutal drop over the last year, right? From $11 all the way down to 34 cents.
An absolute flush. And what that signals to a chart reader is total capitulation. The analysis says sellers are exhausted.
Basically, everyone who wanted to sell has already sold.
Exactly. The selling pressure is gone. So when a positive catalyst hits, the path of least resistance is up.
And that catalyst hit right after what they call the pivot. The stock double bottomed around 34 to 40 cents.
A classic technical signal. A double bottom shows the market is drawing a line in the sand, establishing a strong level of support. It refused to go lower.
Which led right into the breakout. The close at 45 cents and that push to 51 cents after hours, that's cited as the first clean higher high on the hourly chart in weeks.
That's the first technical sign that the trend has actually changed from down to up.
And that brings us to the immediate upside potential, which the report calls the zone. The analysis says if the stock can hold above 50 cents, there is, quote, very little resistance until the $1 gap fill.
And that $1 mark is huge, both symbolically and technically. The report calls it a quick 100% move from where we are now. There's just not much selling history between 50 cents and $1 to slow it down.
Okay, we have to pause here. This is all very exciting, but we need to provide that balance and context. This is, and we have to be explicit, a micro-cap penny stock.
Absolutely. By its very definition, it's volatile, it's speculative, and it's inherently risky. You have to expect huge price swings. This is not for the faint of heart.
So what is the single biggest downside risk? If the merger fails, what happens?
If the deal fails, the entire catalyst just evaporates. The analysis is clear that the stock could immediately retest those recent lows around 34 cents. or even go lower.
So you could lose 25, 30% instantly.
Easily. That is the risk you have to fully understand and accept before anything else.
So why take that risk? The analysis frames this as an asymmetric risk-reward scenario.
And that term really defines the whole play. It means the potential upside, that $8 target, vastly outweighs the potential downside, which is retesting the lows.
So the downside is somewhat contained, but the upside is exponential.
That's the argument. The report is basically saying it's the definition of a high-risk, massive reward play. It's a binary bet on the merger going through.
All right, let's bring this deep dive home. We've got a company, JTAI, with analysts claiming 1,600% upside.
It's a wild claim.
And the bull case seems to stand on two main pillars.
That's right. Pillar 1 is the core asset, the proprietary AI technology, ChatGPT, that could become a pure-play AI stock.
And pillar 2?
Pillar 2 is the merger itself. The extension just confirmed it's still on the table, which removed that immediate threat and brought the arbitrage players back.
So the final synthesis from this report, it offers a really clear proposition for you, the learner.
It does.
You're paying, what, around 45 cents today for a company that has this proprietary AI tech, and it's sitting on official analyst targets way up at $8 to $11.
It's just a compelling contrast, isn't it? A beaten-down penny stock, priced like a failing airline.
But it's holding assets that the rest of the market values, like premium, scalable software.
And the whole thesis hinges on the market re-rating the stock as soon as that last bit of merger risk is gone.
So what does this all mean for you as you're trying to make sense of this? The report itself frames the final question perfectly, and it's the thought we want to leave you with.
What's the takeaway?
Is this just a low-float, high-risk trap that's destined to fall apart? Or is this, finally, the fundamental and technical starting point of the squeeze that takes JTAI straight to that $1 gap fill?
Don't forget to like, share, and subscribe for more.